Why dividends are a game changer. Dividends are one of the most reliable ways to earn passive income. Unlike stock price appreciation, which depends on market conditions, dividends provide consistent cash flow, whether the market is up or down. For example, companies like Coca-Cola and Johnson & Johnson have been paying and increasing dividends for decades. This kind of reliability makes dividends a favorite among long-term investors. What determines how much you need to invest? There are 3 factors that influence how much money you need to earn $1,000 per month in dividends. Dividend yield. The higher the yield, the less you need to invest. Consistency. Stable companies with a history of paying dividends are ideal. Reinvestment. Reinvesting dividends can speed up your progress. Now, let's break down the numbers. Crunching the numbers. Here's the math. To earn $12,000 annually in dividends, or $1,000 per month, divide your goal by the dividend yield. At 2% yield, $12,000 divided by 0.02 equals $600,000 invested. At 4% yield, $12,000 divided by 0.04 equals $300,000 invested. At 5% yield, $12,000 divided by 0.05 equals $240,000 invested. The higher the yield, the less capital you need, but remember, higher yields often mean higher risks. The importance of dividend growth. Dividend growth stocks are a powerful tool. These are companies that not only pay dividends but also increase them over time. For example, if you own stock in a company paying a 3% yield today but it grows its dividend by 6% annually, your income will double in about 12 years. Dividend growth ensures your purchasing power keeps up with inflation and builds wealth over time. Building a balanced portfolio. Let's look at a diversified dividend portfolio that generates $1,000 per month. Utilities 4% yield, $100,000 invested equals $4,000 per year. Consumer staples 3.5% yield, $100,000 invested equals $3,500 per year. Healthcare 3% yield, $100,000 invested equals $3,000 per year. Real estate 5% yield, $40,000 invested equals $2,000 per year. Total investment, $340,000. This portfolio generates over $12,500 per year in dividends. Diversification across industries reduces risk while maintaining steady income. ETFs for simplicity. If managing individual stocks feels overwhelming, dividend-focused ETFs are a great alternative. Popular options include Vanguard Dividend Appreciation ETF. VIG focuses on companies with a history of increasing dividends. SPDR S&P Dividend ETF SDY includes high-yield, sustainable dividend payers. ETFs provide instant diversification and lower your risk by spreading your investment across multiple companies. Reinvesting dividends for faster growth. Reinvesting dividends can significantly accelerate your journey. Here's why. Instead of spending the $1,000, use it to buy more shares. More shares mean more dividends in the future. For example, if you start with a 4% yield and reinvest your dividends, your portfolio could grow by 6–8% annually, thanks to compounding. How long will it take? Your timeline depends on how much you invest regularly. Let's say you can save $1,000 per month. Investing $1,000 per month at 4% yield, it'll take about 20 years to reach $300,000. Investing $1,500 per month at 4% yield, you'll get there in just over 15 years. Beware of dividend traps. Not all high yields are good deals. Stocks with very high yields, think 10% or more, might be in trouble. These companies may be over-leveraged, making payouts unsustainable, cutting dividends soon due to declining revenue. Always research the company's payout ratio, which shows how much of its earnings go toward dividends. A ratio above 80% could be a red flag.